You're going to hear me talk often in my videos about the different kinds of life insurance. Generally speaking, there's two branches to the life insurance umbrella. The one is the permanent, which is what we call whole or index universal life, and one is term. And I'm going to talk about term first because it's the simplest, frankly. Term generally is an expense. It doesn't carry cash value, and it's only for a period of time. We would use things like term insurance to backfill our permanent insurance, which I'm going to talk about here in a second. We would use term insurance generally has a much larger death benefit because we're not so much using it as our go-to retirement cash value policy. We're using it as a backfill, and we're usually using it for a period of time to just handle like the most unexpected of emergencies. So for sudden passing, we use it to pay the mortgage. We use it to pay for the kids' college. Generally, those death benefits, when we're designing those term policies, are going to be much higher. Okay, let's talk about the other branch of the tree, which is the permanent. And that actually has two sub-branches. The first is whole life insurance. Whole life, generally, most policies will have you pay your entire life. It will have cash value, so some people use it for things like retirement because it has not guaranteed dividends, but historically it's never not paid dividends, and those dividends are tax-free. Whole life is the one that very often, depending on the carrier, but most carriers will allow you to access the cash value within the first 30 days of the policy. Whole life is the one that you often hear about people who are banking upon themselves, or perhaps infinite banking if you've been doing a Google search. Whole life is the product that people will generally use for this. And the primary reason is because you have access to that cash value so soon. And historically, they've never not paid a dividend, and those dividends are tax-free. Now, whole life is a great product, but it's not necessarily the only option for a permanent insurance or a cash value policy, or even for banking upon yourself. Now, whole life will have those tax-free dividends, but really the reason why those tax-free dividends are even there is because they're simply a refund of the overbilling of premium. See, if you have whole life, you have to make that payment every single month, and or year if you elected year, and there's no flexibility in the amount. It's like a very finite fixed amount, and because it's so finite, they can then on the back end, the carrier, manage their whole portfolio and essentially give you a refund of that amount you've paid, which is they're calling a dividend. It's a refund of premium, right? And it's generally based on how they've managed those lives. Often with whole life, you're going to see probably about a 3 to 4% average return every single year or refund of what you've put in. So when we have the other branch of the tree, is which I call indexed universal life. And that is my favorite branch of the whole tree. Indexed universal life, just like whole life, has cash value. But generally speaking, it is far more flexible. Indexed universal life, you will still have an amount that you're supposed to pay every single month, but you can add to it or subtract to it. So if you have a job, for instance, like a first responder or a seasonal type of employment, you can adjust how much you're putting in based on what's going on in life. You have a ton of flexibility, as long as you at least pay the minimum. But over time, you do want to pay more than that to basically use it for what I love to use it for, which is retirement. See, we can use it for bank upon yourself. It can be a great tool for that. But my favorite one to use it for is retirement. So Index Universal Life is best for retirement, and here's why. Index Universal Life historically has paid more than whole life. See, Index Universal Life goes up and down with the market. And the market, generally speaking, over the last 20 years has had a return of about 6%. So 6 is greater than 3 or 4, correct? Now, with that said, there may be years where you don't get anything. And that's one of the reasons why some people lean towards the whole life. However, generally speaking, over time, you're going to have a 6% return. So if you look at the whole lifespan of that Index Universal Life policy, you will have more money than you would have had with the whole life. And that's really important. So what we do when we do a planning session with you, and you're saying, which one do I get, Joan? It's really simple. We start with your goals. We start with where do you think you're going in the next few years. because what we want to make as kind of the core piece of that goal is the indexed universal life. That is the core of that long-term planning for retirement. And then if it's something where you're a business owner or perhaps you're a nonprofit and you need to access money sooner for potential counterbalance with working capital, we may consider doing a whole life policy, or we may not. It just depends on what we really think that next year is going to look like and how soon we might have to access cash value potentially from those policies. Lastly, when we do our planning session, we would backfill. And to see how much we would backfill, I would suggest you watch that video we have on what is your true net worth. That is where we often will use a term policy to backfill what we think you need over your whole lifetime in order to make your family whole should you become disabled or pass.